listening to the Millennial's Choice Show, Canada's most trusted podcast on all things real estate, finance, and entrepreneurship. Here's your host, Matthew Ablacan.
What's going on, everybody? Matthew Ablacan here from the Millennial's Choice Show, and we have a special guest in the building today, Trevor Chew. Trevor has a bunch of titles. I love the specific one, which is the Certified Kingdom Advisor, but he's a certified financial planner. And as you know, we talk about all things real estate, finance, entrepreneurship. And one of the divisions of our company is a corporate life insurance agency. So today we want to talk about life insurance and critical illness insurance, disability insurance, and how to really view insurance as a whole. Because typically it's associated with a negative connotation, right, like death, you know what I mean? Or injury or disease or something. But one of our mentors taught us it in a different way and showed us the insurance in a different light. So Trevor, talk to us. What is life insurance?
Yeah, it's interesting. It actually used to be called death insurance.
What?
In the early beginnings. Yeah, I guess they figured out it was a bad marketing ploy, so they changed the name to life insurance. But yeah, life insurance is one of those things. It's really misunderstood, I would say. A lot of the information people research sometimes comes from the US. So you have US tax laws that may not, work with our tax laws. You have a lot of different nuances that may not, translate to Canada as well.
Right.
And just in general, there's so much out there in terms of insurance that you can do. I mean, as insurance brokers who shop the market for clients, like the amount of information that's thrown at us it's so much, right? You got to learn 20 different companies, all their different services and offerings. So, I mean, it really takes a lot of time and effort and knowledge to really learn about this stuff, right? Even being in the industry yourself.
Right. And I think a lot of the themes in our other podcasts is surrounding yourself with the right people and hiring the right professionals. I remember sitting at a table long time ago. I still remember it as a kid. I don't know why this memory stuck with me. And I don't remember anything else about that day except the insurance broker was sitting with my parents. And he's like, think about your kids. Think about your son. And I was so young. And I remember him saying that. And then my parents never got it. They never got the insurance. So I don't know why. I've never actually asked them why or spoken to them why. But I'm sure if I do ask them, they might have, they're immigrants. They don't know a lot of the things that they don't really understand the financial system in this country that well. So they probably might have felt they were being scammed or something, right? But I think the stat is 97% of the insurance companies pay out their policies. Is that true?
Yeah, they pay majority of their claims. I mean, majority of times you're hearing claims not being paid out. It's usually like bank insurance. So typically you'll go get a mortgage at a bank. They'll ask you to buy this creditor mortgage insurance.
Right.
But it's really a third party. They're not really the insurer. You're really buying it, say, from Canada Life or directly from another insurer. Right. But when they do that, there's no underwriting up front. And the person who's filling out the form with you, he's a mortgage person. He's not a life insurance specialist. He doesn't really understand the medical questions. And the person filling out the forms may not understand the questions either. So they've actually had documentaries about this where people have been denied a lot of their claims because they do all the underwriting when you make the claim.
Right.
Opposed to traditional insurance where you do all the medical writing upfront. You take the blood, you're in the medical. They might ask for a doctor's report. They're going to send a nurse to you, weigh you, measure you, all of that. Ask all those questions and vet you thoroughly before they insure you. So when it comes time to pay out that claim, they're going to pay it out immediately.
Right.
Most life insurance contracts have a 2-year contestability period. So you got 2 years. If you commit suicide, they're not going to pay it out. After 2 years, they will pay it out. I guess they figure most people won't kill themselves if they wait 2 years.
Right.
And another one is if you forget to tell them something. Right, incontestability. So the insurance company can contest the insurance policy the first 2 years if you forgot to disclose something. And I had an example of that happen to me. A pretty large case. It was a young guy. He went to the doctor for psychological, depression, anxiety because of COVID. Everyone's locked in, and he forgot to disclose that in the interview. And they did a post-APS, attending physician statement. So they asked for it after the policy was issued, and they discovered these things and they canceled his policy on him.
Wow.
And because it's within the 2-year time frame and he wasn't straightforward with everything, they can do that. But had they waited to the second year and they missed that, it wouldn't matter. They would have to guarantee that policy and honor it.
So just hang on. So the people that are listening, they might have no idea about some of the stuff that we're talking about. So let me just break it down in a simple example. Let's say I lie on my application and I say I'm a non-smoker, but I smoke. 2 years go by, 10 years go by, and then something happens to me and I have to go get insurance. Like I need to get the insurance, right? What happens?
There's a line between fraud and forgetting to tell them something, right?
Right.
So if it's blatant fraud, then they can cancel your policy beyond the 2-year period.
Right.
So whenever you're filling out applications, it's always important to be as honest as you can. I always advise work with a broker and tell the broker everything, because the broker's job is not to tell your business to everybody. Their job is to figure out the right insurance company to place you with, and to work with underwriting, ask them the questions before they submit the application.
Yeah, this reminds me of the episode I was speaking with Amir and Danny, from Danny from the real estate and mortgage side, and Amir from the mortgage side. And they said the same thing. When we're preparing a mortgage, we want to know the story. Like, don't leave anything out. You have to tell us everything. Don't just tell us you have $100,000 down payment. Tell us where it's coming from, as an example. So just backpedaling a little bit, when you said the creditor's insurance, when you're getting a mortgage. So what that is, guys, is it's totally optional, but it's good to have something in place. It's better than nothing. But what happens is typically your payment stays the same, but your coverage goes down as you're paying down your mortgage. It only covers the mortgage. Right. So there are usually, and I'm sure you'll find this too, usually people can get a better life insurance policy for the same or less money.
Yeah, unless you're completely uninsurable, but then you might not even qualified for it. But most times than not, if you just do the full underwriting, it'll be much cheaper, because again, you're going directly to the insurance provider instead of going through a third party, and you're doing all the underwriting upfront. It's kind of like a group policy at work. When you get a disability or life insurance at work, you're paying the premium for everybody else involved in that risk pool. So people who are older, who have health issues, they factor that in and they charge you or the employer that rate.
Right.
And the other thing to note too, when you have group insurance at work, people say, oh, I have group insurance at work. But people don't realize if you get older or you retire or you terminate your employer or employment, and you leave, they don't give you all the full conversion options. Like most companies will only give you a limited shelf of conversion options that are not the usual conversion options if you did the full medical.
Right. And the idea of underwriting is, from an insurer standpoint, guys, always put yourself in their shoes. They want to make sure that they do their due diligence on you.
Right. Yeah.
Just like getting a mortgage. They're not just going to give you money to get a mortgage. They want to see your income, your credit. They want to see everything about you, your down payment, where it's coming from. Same idea with insurance. They want to they want to check your blood. They want to check your urine. They want to make sure that, especially if I'm 29, but I got my insurance. I think, Trevor, I was 28. I can't remember, but it was a significant amount for my age. So they're like, you know what? There might be something wrong with this kid. He wants insurance for a reason. Let's do the blood work. Let's do the urine. Let's do all that.
Yeah. Pre-COVID, certain amounts, $1 million, $500,000 required blood work and urine. But currently right now, because of COVID, you can go up to $2 million from ages 18 to 50. No fluids, no blood or urine.
Wow.
They'll probably just ask for a doctor's report if they need one. So
why is that? Why did they change that?
Because everybody, dealing with COVID, and I guess they work with reinsurers. So reinsurers are large insurance companies that reinsure larger blocks of risk that an individual insurance company can't have capacity to hold. And usually they'll, relax the rules or they'll work away, actuarially speaking, to make it work, right?
Right.
So I guess they figured those age groups and type of questions that they ask, and between that and your doctor's report, they can pretty much find most of the information they need through your doctor's report and those questions.
Right.
Yeah.
That's awesome. So another thing that I got for myself was I got critical illness coverage, and specifically it's an overhead insurance policy, right? It covers some of my overhead at work.
Are you talking about the disability insurance policy?
The disability insurance.
Overhead. Yeah.
Disability overhead. Can you talk more about that?
Yeah. So whenever I talk to people about risk management and insurance, I always start out with critical illness first, because it's the most likely to happen. Logically, if you're going to insure something, what's most likely to happen in your lifetime? And that is critical illness. You got a 1 in 2 chance of getting cancer in your lifetime. I personally had a lot of experience with people who have cancer. My mother, my best friend, his mother. I've lost a lot of people to cancer. So I believe that statistic, right? So I always talk about that first. And there are ways where you can get that type of insurance where you can get all your money back if you stay healthy. So really the only cost is your opportunity cost. What would you have earned on, $100, $200 a month at the bank
Nothing.
Probably not much.
You'll lose money.
So why not get, access to 100,000, 200,000 if you were to become critically ill, or get all your money back if you stay healthy. With disability insurance, is a little bit different. Critical illness pays you a lump sum benefit and then contract's over, or you stay healthy, take your money and the contract's over. Or with disability, they just pay you an income every single month you're disabled for as long as you can't work, usually until age 65, sometimes older.
Okay.
So business overhead with disability insurance, you have to have income for them to insure your income. So usually they'll only insure about 70% of your income. Nobody's going to insure more than that, because then you have no motivation to return to work and you'll always stay on disability. Right. So most insurers will insure up to that. But for self-employed people who have, a lot of deductions, they're not going to show that type of income on their tax return. They need another way to insure their expenses, and disability overhead insurance is a way to do that. It's not really based on your income. It's based on your expenses and your overhead of running your business. So that's a good way for self-employed people, incorporated people who don't show as much income to get those types of policies.
And I think the policy that I got says that after 20 years, if there's no issues, like I never had a claim, I can get my money back. I think Desjardins. Or manual? No, Desjardins.
Desjardins. So I know a couple companies used to do that. I personally have a policy from Le Capital. If I don't make a disability claim, I'm going to get back all my money at age 65 or minus 2 times my claim. They don't actually offer that anymore. Now it's 75%. There's only one carrier left in the industry that offers 100% refund if you were to cancel it or stay healthy, right? So that's the only provider left. And they only go up to, I think, 4,000, 5,000. They don't have a high limit. Right. So I mean, if you are in the market, you do have a business, it makes sense to insure it.
Right. It's a no-brainer. Like if you don't make a claim, you get some of those monies back, if not all.
Yeah, it's the same thing as the critical illness policy. Yeah. I mean, if you get all your money back, the cost is your opportunity cost, right? Right. And disability is the second most likely thing to occur in your lifetime. Right. Yeah.
There's a policy that I've referred some of our clients to you about, and that's a policy that invests in the stock market or gives people the ability to play with stocks.
So there's actual investments that you can buy through an insurance provider or a mutual company, and then there's actual insurance policies. So within life insurance policies now, usually there's term insurance. Term just means you rent the insurance. It's for like a 10-year term, 20-year term, 30-year term, and then that's it. There's no cash value. You just rent the insurance. Hope nothing happens, right? Term insurance, probably less than 5% actually get paid out, because the likelihood of you passing away during that term is very small. That's why it's so cheap. Right. Like a 20-year-old could probably get $1 million for like $18. 30-year-old probably like $30 a month. Right. So it's really cheap. And then the other types of insurance are permanent forms of insurance. Those they can be used as investment vehicles. And what's neat about these insurance policies, and a lot of people don't realize this and they ignore, is that life insurance is tax-free. Critical illness benefits, disability benefits, if they're paid by you, are tax-free. Life insurance benefits are tax-free, but also growth within a life insurance policy is also tax-free. So for those who have maxed out their TFSAs, you really have nowhere else to invest tax-free other than insurance policies out there, which is the very reason why a lot of wealthy people, they put their money into these policies. Me personally, I know I'm going to be in a higher tax bracket when I retire. So for me, RSPs don't really make sense. I have rental income, I have business income, and I don't plan on retiring from my business, right? I don't really believe in retirement in that sense. Maybe just slowing down, taking sabbaticals. But go on vacation, stuff like that. Just take breaks every now and then, right? Yeah. So that form of permanent insurance, you really want to consider if you have the potential to max out your TFSA and you won't have any more tax-free room left. Because that is the other avenue you can invest tax-free. So within that world, you've got whole life policies that are non-participating. There's no dividends to them. Okay. And then you have whole life policies that are participating, like dividend insurance, basically. Right. So what these policies allow you to do is participate in the risk of not the whole life insurance company, but a specified pool of that life insurance company. So you have to remember, life insurance companies, their specialty is assessing risk, actuarial data. They use scientific actuarial, calculations to determine how many people are going to pass away per 1,000. And these tables go back to, 1800s, 1700s, even older, right? So, and they've accounted for like World War I, World War II, like periods of mass depopulation, they've already accounted for. So all that is factored in already, right? So when you're participating in the profitability of an insurance company, what you're really participating in is their expertise to calculate risk, mortality and morbidity, how long a person lives and how long, until a person passes away. Insurance companies are very good at that. In fact, in 2018, it was estimated they collected about, I think the number was 20 billion in premiums.
Wow.
I could be mistaken, it's probably more. But they only paid half in claims. And as you know, they pay majority of claims. That's just a result of spreading risk over a large population. It just makes it easier for everybody to cover that risk, and it makes it affordable for everyone else, right?
So I actually have a whole life policy.
Right.
That's what I got. And the type of policy that I have from Empire Life, it's an 8-year policy.
Right.
And I pay for it for 8 years, and then I never have to pay for it again.
Yeah.
But every year it's building dividend, or no, not dividends.
So, yeah.
I have dividends,
yeah.
even though they're not guaranteed.
Right.
But I have something called cash values.
Right. Yeah. So that contract, and most whole life policies will have a form of guaranteed cash value. Is good as a long-term GIC because it's contractually guaranteed. It doesn't matter if the economy fails, that amount is guaranteed. Or if a life insurance company ever does fail, 85% is guaranteed by assurance. So life insurance companies are very solvent. I mean, that's one question most people ask. If we're going to put all this money into these policies, is it safe there?
Right.
I would argue it's safer than a bank. I mean, there's only been 4 life insurance companies that have failed in the history of life insurance in Canada. 2 made a full recovery. The other 2, 99%, 95% full recovery, with the rest transferred to a solvent company. You compare that to banks, there have been at least 10 times that amount. So at least 40 bank failures since 1967.
Wow.
So life insurance companies, you have to remember, they're not into lending and trying to make money off spreads and fees and stuff like that. They make money off calculating people's risks, right, over the long term, investing that money. So with dividend policies, you don't really pick the investments. They pick it all for you, and it's not really based on investments. It's really based on about 30% to 40% is based on how well does the insurance company manage risk, how many people pass away in that pool, and how many people lapse that policy. Other things that factor in are like taxes and expenses, which are pretty normal across the industry, and then investment return. And majority of investment return is mostly in fixed income, pretty safe assets.
Right.
And if you know much about interest rates, we've been in the lowest interest rate environment in like 5,000 years. Okay.
Yeah.
And as a result, bond yields are really, really low. So you can imagine, we have low interest rates, and these dividends are still kicking out 6% in a low interest rate environment. If I show you tables going back to the 1980s, these dividends were kicking out like 16%, 12%, on par when, GICs, government bonds were issuing about the same, right? Right. So it's an asset class that's very unique because it can give you a return that's very consistent. Yes, the dividend's not guaranteed, but I mean, majority of insurers have never failed to miss a dividend in over 100 years. I mean,
so my dividends, I don't actually collect it.
It's reinvested.
It buys
usually.
me more insurance, right?
Yeah. So typically what you want to do is you want to reinvest it, because if you do it any other way, it becomes taxable. So when you reinvest in a life insurance company, it's tax exempt.
Right.
Each insurance unit you buy is almost like a share in that pool of risk. You're buying into that share pool of risk, and in turn, you're getting dividends that you're entitled to and more cash value that you're entitled to.
Right.
So you're really in buying like shares of insurance almost, okay?
Right.
And that cash value continues to grow. So you got a guaranteed cash value, and then you've got a cash value that includes a dividend cash value. So the dividends have their own cash value, and that keeps on accumulating. As of lately, a lot of insurance policies back in the days that got a bad rap were because they didn't have these guarantees that we have today. Today, we have a lot of guarantees that, earlier generations did not have. Like you have an 8-pay in the industry. That's one company that does it. You have 10 pays that are fully guaranteed, meaning if the interest rate changes, if, something happens in the economy, it doesn't matter. It's fully contractually guaranteed.
Yeah, mine's pretty cool because I pay for 8 years. I have coverage for $500,000. And then the total after 8 years is like, I think I've paid about, like $80,000 to $90,000, right. But I've secured $500,000, for my family one day.
Yeah.
That's a pretty good deal.
Right. And not only that $500,000 after a certain point will start to increase depending on how you set up that policy. So these dividend policies are good for people who, one, will probably max out their TFSAs. They got a good emergency fund, and they have a long life expectancy. They really reward you for living longer. So for a child, this makes absolute sense, because how they hedge the risk of these policies is they usually buy like a 30-year bond or something to hedge the risk. There's no there are 90-year bonds, but they're not going to buy them to hedge this type of risk, right?
Right.
So with children, they're taking a lot of risks, right, in ensuring them long-term that way. So it's a great, way to pass on inheritance to children, because you can transfer the policy to the child tax-free. So a lot of wealthy people, they use this as an intergenerational wealth transfer strategy. For yourself, I mean, usually with those type of policies, the one you have in particular breaks even probably about year 14, guaranteed. If they never pay a dividend, guaranteed is your value of your cash value is going to be worth your deposits no matter what.
Right.
Probably by year 12 or earlier, that's probably going to be your break-even point based on current dividends. And again, current dividends are pretty low. If interest rates increase in the future, which they probably will, we're like close to zero, the dividend will increase as well, right? So buying it right now, you're probably looking at it from like, worst case scenario almost, right? Can a dividend decrease a little bit more? Sure, it can a little bit, but as interest rates rise, the dividend will increase as well.
Yeah, well, even because of the pandemic, they've printed so much money and injected our system with so much dollars that they're going to have to increase. Traditionally, it's either they go bankrupt to solve their debts, the government, which is it's not going to happen. But it's either that or they raise the interest rates to pay off their own debt with cheaper dollars.
Yeah. The issue with that is when you have so much debt, how do you pay it back? I mean, in the past, a lot of governments have devaluated the value of their currency in order to pay it back with, money that's worth more today, right?
Yeah.
So yeah, you do run into those issues as well in the economy. So which makes life insurance very attractive because those dividends, they can never be negative. And once they pay them to you each year, they can't be taken away from you.
Right.
So I almost, usually when a client has non-registered investments that are attracting taxes, they got stocks paying them dividends that are being taxed. They have mutual funds or stocks making capital gains. Half of that is getting taxed, or they've got interest income that's getting taxed. I usually position this as a replacement for their fixed income portion of their non-registered taxable investments. So usually with fixed income, I mean, GICs right now get you 1%, a bond, 2% if you're lucky right now, but it's taxable. So if you're in the highest marginal tax bracket, half of that is gone.
It's gone already.
1% is really 0.5%, 2% is really 1%. So why not take that cash wedge or that fixed income portion and slowly, not all at once, because you can't really put it all at once into policies, but slowly over 8 years, 10 years, 20 years, put it into this type of policy that allows you to grow money tax-free. And now you can have something that's less volatile than a government bond or GIC, but performs almost like an equity or a stock market. These dividends are right now like 6%, average 30-year, maybe 9%, 8%, tax-free. And it's just as safe as cash, and it's just as liquid as cash. Right.
So those cash values that I have in my policy, if I want to at some point call the insurance company up and say, look, I got $50,000 in cash values, give me a loan. They easily do it, right?
They have to give it to you. Yeah, it's contractual. And that's another thing that people don't realize. When you buy life insurance, especially permanent life insurance, you're leveraging your most valuable asset, which is you. Right? Human life, you can't put a price on human life.
Right.
So once you do that, it gives you special rights and privileges. You can now demand a policy loan from the insurance company directly, or you can just take it to your bank down the street. Don't go into any local branch. They probably won't understand what you're trying to do. You would have to go to a specialty division of each bank has a specialized lending division that you go to, and you can get a loan off the life insurance policy. Right. So typically the first 20 years or so, you can probably borrow directly from the life insurance company without taxation. There's something called the ACB, adjusted cost base. Right. Basically, it's a formula to calculate how much your policy kind of costs in a way. And once you exceed that amount, that amount that you borrow in excess of that becomes taxable as income. So you want to make sure you're careful. You talk to an advisor before you do these things. You ask, what is your ACB before you take a policy loan? I mean, you get advice before you do it. But it's pretty easy to do. I do these all the time with my clients. They call me. I send them a one-page form. They sign it, and they get the money deposited into their bank account in like 3 business days, sometimes sooner.
And even though you take that loan, every year those values continue to go up.
Yeah, and so that's the neat thing about it. People don't realize is when you take a loan, you're not borrowing directly from your life insurance policy. All those values and those cash values stay in your policy and continue to accrue tax-free. You're actually taking the life insurance company's money. They're giving you their money, and you don't have to pay it back. You pay it back, and you can defer payment until you pass away because you have the life insurance.
Right.
So you almost think of the life insurance almost like your lending limit in a way, right?
Yeah.
Yeah.
I think it's pretty cool.
Yeah, it's pretty cool because a lot of people who started their businesses, this is how they started their business. JC Penney, Walt Disney, the guy who started McDonald's, nobody would lend them money to start their business. Yeah. So they borrowed from their life insurance policies.
Yeah, former Senator John McCain, before he passed away when he was running for his presidency,
right?
He funded a lot of his campaign through his life insurance policies.
Right, yeah. Because you can borrow tax-free from them. If you take it to a lender, they'll lend against it. It's got guaranteed cash values, and if you pass away, they're going to get their money.
Right.
In fact, you can get a lower rate on a life insurance policy than a house. Right. I often say this in my presentations. When you get foreclosed on a house, the bank's got to hire a bailiff or warrant to change the locks. They got to hire a real estate agent, pay them 5% commission. They got to hire a lawyer. They got to hire. They got to do all that stuff and finally sell the house to recoup their money. With life insurance, if you don't pay, they take the guaranteed cash value. If you pass away, they get the money. So there's really little to no risk for a bank to lend against life insurance.
Which is why the rates are so low.
Which is why the rates are so low, yeah. And if you do that, you do a collateral loan directly with the bank, you do have to service the interest, but it's tax-free. When you take a policy loan directly from the life insurance company, it doesn't require you to pay anything. You don't even have to service the interest.
Wow.
Yeah, so it's different that way. So you can literally create your own banking system if you get a large enough policy like this.
Right. And I think the problem is with a lot of younger people, it's not top of mind.
Yeah, nobody wants to talk about death and estate planning. And it's the last place you would look for in terms of, investments, because it's something that's not really understood. Even within our industry, a lot of advisors, I run an agency that trains other advisors and accountants.
Right.
They don't take courses necessarily on insurance. I mean, the insurance advisors do, but accountants don't really. Right. Unless they go out of their way. So insurance is a realm that's really misunderstood, and majority of insurance that's out there is sold through the captive agencies, like agents who only work for one company that have access to only one company or one type of insurance. Yeah. So it's very limited in that space. So and most brokers also, they may not deal with every single company as well, right? So back in 2006 to 2010, I was a mortgage broker too. I had to learn lending products from so many different carriers and lenders, and also learn the insurance side and also do financial planning. It's just too much information. You can't specialize. Yeah. So I opt to just give up the mortgage license, just specialize in financial planning and insurance.
Well, I mean, that's why we have, at our company, we have the group of companies, but you don't see me preparing mortgage files or preparing insurance files. If any of our clients want to talk about insurance, you call Trevor. If anybody wants to talk about mortgage files, you call me or you call Danny, whatever the case may be. Because I like to specialize. I like to focus on the one thing.
Yeah.
But it's definitely something that I think should be a part of your plan, your financial plan.
Absolutely. Yeah.
Especially if you're buying real estate.
Well, yeah, it's a must if you buy real estate. I mean, the whole idea is people, you buy term invest, the difference is self-insure, but you're ignoring a lot of the taxation issues there. Let's say you do it within TFSA. Well, TFSA limit is only $75,500 right now. If the government allows you to put it more, or maybe they might axe the whole program altogether. Right. Who knows, right? But it's not a large limit. So if you try to invest outside of that, all your investments earnings are going to be taxable. When I run illustrations for all my clients, I show them all the options out there. I try to choose the best companies of each type of policy out there, and I show them the internal rate of return. Life insurance is one of the few things I can tell you exactly what the internal rate of return is going to be after tax.
Right.
I can't do that with investments because I don't know what the tax rate is going to be in the future, and I don't know what the investment is going to do.
Right.
With life insurance, it's guaranteed. I know what it's going to pay it out, and I know it's going to be tax free.
Right.
So usually, somebody in their 50s, 40s, they'll probably net internal rate of return of like 4% on some of these permanent policies. 4% may not seem like a lot, but when you add taxation into that equation, that's equivalent to like an 8% GIC.
Right.
That's really high, and that's guaranteed, right? If somebody offered you an 8% GIC guaranteed, what would you say to that, right? In today's market.
So it's no brainer.
Yeah.
So right now you work with over 20 different insurance companies.
Right. Yeah.
The RBCs of the world, the Canada Lifes, the Empire Lifes, Equitable Lifes, all these big companies, right? So you don't work for them.
No, so that's a misconception also. So as a financial planner, as a certified financial planner, I work for my clients. Right. So my job is to go search the market. Well, before I search the market, to understand your situation. So always with the first consultation, I ask a whole bunch of questions. I don't tell you much about me unless you ask me in the first meeting. But I really get to learn about you. I get your cash flow, I get your net worth statement started, and I create a financial plan. And then I show you all the options out there.
Right.
My job is to serve the client. I work for the client, not the insurance company.
Right. So how does it work right now in terms of I approach you, I'm 29 years old, male, non-smoker, I want insurance.
Right. Yeah. So
like what do you ask me?
Yes, I send you a Calendly link. You click a link on my calendar. We set up a time, maybe a phone call or online, maybe 45 minutes. And I just ask you a bunch of questions. I would ask you, I start off with like, what's your name, date of birth, some basic questions.
Right.
Do you have a will? Do you have a power of attorney? Do you have debts? What is your cash flow? What's your income? What's your expenses? What are your savings? And then some questions in between about health and other things as well.
So can you kind of give us a breakdown right now, I know we're catching you like none of this is scripted, by the way, for you guys who are listening. Do you think you can, from your experience, tell us what like a typical policy would cost, maybe if you're 18 years old?
Oh yeah, if you're 18, 29-year-old, you're under 30, it's going to cost you like $1 million right now, probably $30 a month, probably less if you're younger.
And that's the term insurance?
That's term. I typically suggest clients get term 10 life insurance. The reason being is I find if the broker's not doing his job, then you might keep it for the whole term. But if the broker's doing their job, they're going to call you every 3 years, 2 years, or every now and then to search the term market. The term market is so competitive. I can call you 5 years from now, and if you're willing to redo medical questions, you can probably get a fresh 10-year term, probably cheaper sometimes.
Right. So the thing about term, it's like, look at it as a phone contract, and you're getting a phone contract from one of these companies for your cell phone,
right? And
it's locked in for a certain amount based on whatever the phone company is going to guarantee you that they're going to give you in terms of service. And it's for 2 years or 3 years.
But you're not locked in. You can stop without penalty if you want. Yeah,
that's the difference with what we call term. And when you say term 10, it means it's that monthly rate is guaranteed for 10 years.
10 years, exactly. Yeah, you typically don't want to let it renew because typically the renewal rate is like 4, 5, 6 times the amount of your original price. You want to redo a medical question. And most term 10s allow you to exchange for a term 20 or 30 within the first 5 years without medical evidence, and also convert to a permanent policy without medical evidence.
Right.
Now, I always tell the story. I had a young marathon runner, 26-year-old, healthy as a horse, whole foods diet. She wasn't sure if she needed the term insurance. We got her the term insurance, and next year she had type 1 diabetes out of nowhere.
Wow.
You never know. I never assumed that someone's young and that they're healthy, that, they're not going to get something down the road.
See?
Because you never know. And if we haven't did that, she wouldn't be able to convert that policy into a permanent policy.
Right.
That client even moved to the States and still was able to convert without medical evidence. And because the taxation is better here in Canada and the dividend is better here in Canada, she was better off getting the policy in Canada than the US.
Right.
Yeah.
Right. What do you recommend for a business owner who is incorporated and has a lot of liquid cash in their account?
Yeah. So if they have a lot of retained earnings in their business that they're not going to use, so it really depends on what stage of the business you're at. Are you in the growth stage? Are you in accumulate? Are you in the stage where you want to slowly wind down and leave to the next generation? We're in the biggest wealth transfer ever in history. $1 trillion is transferring to the next generation. 70% of businesses are going to sell or pass on their business to the next generation.
Right.
So it's a very important topic, and life insurance is one of those vehicles you can use to pass on those shares in one of the most tax efficient ways. So one of the strategies is called an estate bond, is where an individual owns shares in a corporation. They want to pass on those shares to the next generation. Typically, if you were to just leave it alone and just let the business do its thing and let the shares go through probate, or maybe you even have a private will and the shares don't go through probate, the beneficiaries would take over your shares, and then from there they would have to take money out of their corporation through dividends.
Right.
Now, dividends are taxed, and if you're lucky, $1 million is probably going to be worth less than $700,000 after tax. If you take that same money that you're going to leave in the corporation and use that to fund a guaranteed permanent life insurance policy that is owned by the corporation, paid for by the corporation, and the corporation is the beneficiary, it creates what's called a capital dividend account credit, a CDA, which is a tax-free dividend. It's a notional account by CRA, which basically states the life insurance benefit minus the adjusted cost basis or the cost of the policy equals your tax-free dividend that you can pull out of your corporation tax-free. So oftentimes, we'll do this for like an older client, 70-year-old, 60-year-old, sometimes, 80-year-old client who wants to pass on shares. And typically, they can get, at least $1 for $1 out of their corporation. And that's a good deal because typically if you don't do this, you're going to get 70 cents on every dollar out of your corporation after tax.
Right. So even though you're paying for the insurance, the way the benefit works through CRA,
the tax savings pays for it. It just pays for life itself. Insurance is simply buying tax-free money at a guaranteed discount price. Right. For that client, we know $1 million benefit will cost them maybe $600,000 spread over their lifetime.
And the other thing is, it's like we didn't touch on it at the beginning, but like we insure our jewelry, we insure our houses, cars.
Yeah.
We don't insure ourselves.
I always give this analogy in my presentations. If you had a goose that could lay golden eggs, which would you insure? The goose that lays the golden eggs or the golden eggs?
The goose.
Everybody tells me the goose, but the reality is we're all insuring the golden egg.
Yeah.
The jewelry, the car, the home. We're not insuring the goose ourselves. We produce the income. We are the most valuable asset. A typical person working from age 40 or so is going to make, a couple $1 million, $2, $3, $4 million from now to age 65, depending on their income.
Right. Yeah. That's what a lot of the philosophy of Dave Ramsey.
Yeah.
He talks about, I forget the debt part of it, but he talks a lot about you are the biggest asset. That you have to focus on producing income.
Right.
And I agree with that. But the other factor, like the X factor, is like life happens.
Yeah, the unknown. You don't know. Nobody
Yeah.
knows. Unless, I always say this, the best type of insurance to have is the one that's enforced when you die.
Right.
Can you tell me when you're going to die? And unless then, there's no real answer. So there's no right answer whether, term, whole life, UL is the best. It really depends on your situation. Me personally, I have all of them. I have disability, I have critical illness. I have like 7 different life insurance policies. I have whole life, universal life, I have term, and they serve different purposes. Right?
That's awesome.
If you're into real estate or if you're going to buy a property, you probably definitely need some form of term. You're probably not going to buy $1 million of permanent insurance, and you might not have $1 million to self-insure either.
Right.
Another important thing is if you're in real estate, you may want to consider permanent insurance, because a lot of people don't realize this. All your second properties are deemed disposed of at fair market value when you pass away.
Right.
My first experience was my grandfather was a real estate investor. He bought a whole bunch of these properties, out in Alberta. He put them into corporations, holding companies. And when he passed away, CRA wanted a tax bill on all those properties, even though we didn't sell them. He passed away in 2008. Imagine trying to sell all these properties in 2008 in Alberta. And these houses have like wallpaper from the 1970s on them. Like it's not easy, right? And then you got pressure from, like, my dad was the executor. So you got pressure from all the other beneficiaries to settle the estate and hurry up. Your typical estate takes like a year, 2 years, even more if people contest it to settle.
Right.
So life insurance is a great way to bypass that whole probate process.
Yeah. So about that's actually a really good topic. I had a client once who I learned about this through our real estate business, and she was selling her late father's condo, and it was like a million two condo. It was a really big condo, nice size condo. And I'm like, why are you selling it? Like, why don't you just keep it? It's there. It's pretty much paid for. She's like, we're getting hit with a tax bill. Yeah. That's like $1 million because he had other properties. And in order to pay for that tax bill, which is incorporated, like this condo is incorporated into that, you have to sell the condo, which is kind of like a little bit backwards, because like you're going to sell the asset to pay for the gains on that asset. It's really backwards. Yeah. But that's the law.
Yeah. People don't realize that. Yeah. When you pass away, unless you have a surviving spouse, then there are rollover elections that you can do, and certain tax planning strategies you can use. But for the most part, if you leave it to an adult child, it becomes taxable. Yeah. Even though you didn't sell it. So, and a lot of people don't account for, yes, it does cost a lot of money, but it could cost you your family and your family legacy. I think that is most costly, if anything.
How does one know how much life insurance to get? What would be some things to consider?
Yeah. So typically I give them a calculator. It's like a simple spreadsheet I would give them, and they just type in how much mortgage they have, how much debts they have. One area they should really consider is income replacement. And a lot of people, they just buy enough insurance just to cover their debts. Right. I had a 26-year-old pass away in my practice. He left a young widow and child. We got him just enough insurance because that's what he insisted on. He had group insurance at his work. The policy I got him paid him out in 2 weeks. I was able to give them a claim on the death claim, a payment to the widow in 2 weeks. The group insurance took a year to settle because it's post underwriting. None of the underwriting is done up front. But the widow had to remortgage the house. She had to go back to work. Imagine trying to have, she had like a 2-year-old child or a 1-year-old child needing daycare, having to go to work and grieve and pay all the bills. Yeah. The reality is people are not going to be able to do that, right? So even to this day, they have debt. I really wish I pushed for more insurance. So I always stress, if you got young children, you want to replace your income until they're at least self-sufficient. Right. Yeah. Yeah.
So typically the formula, what do you recommend? 20 years of income?
So if I usually go by years. So if your child is 1 year old, then I would say at least for 18 years, 17 years, replace that income.
And then if you have any mortgages, any debts,
add that to it, and plus final tax liability. So you want to talk to a professional who understands tax law, who understands, final tax liabilities as well, especially regarding second properties and also non-registered investments. Right. Right.
We're going to wrap up soon. I want to leave everyone with one last thing, and I think it's a very important part of all of this, and that's legacy. And I mentioned at the beginning, you're a certified Kingdom advisor. Yeah. Tell us a little bit about that, and then tell us a little bit about how important it is to leave a legacy and to give back.
Yeah, so Certified Kingdom Advisor is a designation offered by Kingdom Advisors. So they have a Canada division and a US division. It was an organization, a nonprofit started by Ron Blue. He started a really successful accounting firm in the US. I think his firm was like top 5 in Forbes. And he kind of broke away from that to start an organization to incorporate biblical wisdom in advisors practice. So the organization is for advisors, financial planners, insurance agents, accountants, CPAs, lawyers.
Right.
And what we do is every month we have study groups. So I lead one of the study groups. We focus on a different topic of how to incorporate biblical wisdom. It's a really interesting course, one of the most interesting courses I've ever taken. And I didn't realize, I've read the Bible a couple of times. I didn't realize how much it actually speaks about stewardship, money management, even monetary policy and fiscal policy for a nation. All of that is in there. There's over 2,300 verses. And nobody ever talks about it. Usually you go to church, pastors don't really talk about it because they feel maybe there's a conflict of interest there, or they feel funny about it. And advisors, financial advisors don't talk about it either.
Right.
So one of my goals is, building a firm that incorporates that into our practice. So we look for advisors who want to incorporate biblical wisdom, who want to become a certified kingdom advisor. And it just really looks at life at a different perspective. It's not so much looking at life as just making money to make money. Money can't make you happy at the end of the day. The whole idea is, giving is one of the key aspects of life, and it is one of the components in the financial plans that I make, to give generously. Science and research has showed us, that part of your brain that's stimulated by food and reproduction is stimulated through altruism and giving and helping people. And it may make your life more pleasurable and more fulfilling.
Right.
So using that, I think people can build a lot of significance in their life. I think we have a lot of mental illness, but we're the wealthiest nation in the world.
Right.
But yeah, we have so much, depression and anxiety. I think it's because people don't have that purpose that they need for in life. Yeah. And I think giving back is a great way to do that. So I call my company Legacy Financial because we focus on building a legacy, protecting a legacy, and leaving a legacy. Not just monetary, but also, your values, your goals, your traditions, stuff like that you want to leave for a family.
Yeah, I find I'm the most happy if I know my work is serving others.
Right.
Like that's what it is. Like it's actually our division MC Academy. When we go into schools and teach about financial literacy, we don't charge the schools. And that's, we end up having the most fun. We enjoy ourselves, like everybody here that's taken part of that.
Yeah.
We haven't really done as much now because schools have been shut down for the most part. But yeah, like I agree with that. And you know what, regardless of what like faith you believe in, it seems like the studies have shown when people are giving, they are getting way more benefits. Right. They are happier people in general.
Yeah, definitely. And these are principles that are transcended. They transcend economic conditions and time. They're consistent throughout time. Right. So like spend less than you earn, avoid the use of debt, plan for emergency, plan for long-term goals like retirement, and give generously.
Right.
So within that, there's a whole bunch of other things like investing, how you invest, the type of companies you pick, your social impact when you invest, viewing investments as not just trying to make money, but also making an impact. People don't realize when you buy stocks, you're a shareholder. You can attend the meetings. In fact, there's a story about apartheid in South Africa that was actually, I think it was Ford or General Motors. They had Episcopal shareholders that pushed for them to go against apartheid. And they actually stopped it. And a lot of other companies followed suit and actually made that change to go against apartheid in South Africa. So there are lots of examples of it. Ordinary investors like you and me owning shares in the company, attending the shareholder meetings, and making shareholder resolutions to help change. And I would argue, these things can profoundly change our world. Right. Other than politics, because you think about politics are lobbied by these corporations. They fund a lot of these people's campaigns. So if you can influence corporations, you can influence a lot of our world, right?
Yeah. And I think I was watching an interesting episode on the Rich Dad channel, and he was talking about how he was investing in coal in China, and he realized how much pollution it was going to cause, but he was a little torn about it, but he's a capitalist and he's like, I was, just in it for the money. Right. He's like, but more so now, he's learning more about opportunities, let's say with green energy and clean energy, and how you can also make a lot of money doing that, but also having a social impact too.
Yeah. The funny thing is you actually might earn a better return investing like that. There's a big boom right now of ESG, responsible investments, where they put a filter on the type of investments that you can invest in, and they invest only in companies that have good corporate governance. They got diversity across their boards. They're not polluting the environment. Typically, they're run better, so they're more profitable. And some of the funds, they do have a track record of better performance.
And those companies now, like even Apple, they've made it part of their mandate.
Yeah,
to leave
exactly. You have to remember, we have a lot of power as consumers, right? Like half of our nation's taxes are paid through us individuals. Right. If we don't like something, we can tell a company we're not buying your product.
Right.
And they won't make it anymore. Right. So I think it's important that we exercise and we realize that type of power we have. So those are one of the ideas out of Kingdom Advisors and those. And there's a lot of other ideas that are out there as well. Like retirement is another idea that I think is sold to us. You work your whole life like a horse, and all of a sudden you retire.
Yeah.
What do you retire to? Most people end up depressed that way, right?
I've never had when I was younger, I'd say, retire by 35, become a millionaire in real estate. And as you get older and you do love what you do. And if you're in it, you're like, why would I want to retire? Yeah.
You build significance. You like what you do. Like, why would you want to stop that? Our society pushes this narrative that when you become older, you're obsolete, but that's further from the truth. You have so much experience and knowledge. You need to pass on to the next generation.
Yeah. We just celebrated my father-in-law's 60th birthday. Yeah. And he's like, some people just always want to be like young. I'm like, I know. I'm like, but you, like in this age, your best days are ahead because you have so much knowledge and wisdom and experience that you can apply, right? Trevor, this was an awesome talk.
Yeah, great. Yeah, I enjoyed it.
Where can people find you?
They can reach me on LinkedIn, on my website, my phone number, Trevor Chew. Yeah, 416-738-9721. You can just call me if you want. Yeah.
And you can reach out to us. We'll connect you with Trevor. You can follow us at Millennials Choice. You can follow me at Matthew Ablican, at Trevor Chew. And this is the Millennials Choice Show. Thank you for all of you who listen. And we're out.